Well, good afternoon, everyone. Thank you for tuning in. I'm really excited this afternoon to have a brief conversation with John Gill, just to cover some of the basics of fixed income and the bond market and why it's an important part of a diversified portfolio, with the hopes of demystifying or helping to explain some of the uh, more complex elements of these types of investments and why we believe that they're an important part of our client portfolios. So, who better to have this conversation with than John, who started his career in the municipal bond department at Investment Corporation of Virginia, where he learned all about the ins and outs of these types of investments. So, John, thank you for joining me for this conversation. And maybe we'll get started just with a really high level question to level set all of our listeners here. So, can you tell us what is a bond and why is it called fixed income? And what are the main types of bond investments that our clients should know about?
Thanks, Andrew. Yes, so a bond is really a contract between a investor or lender and a borrower. And so in the bond market, there are several main areas. Corporate bonds, which are obviously when corporations are needing funds, they go to the bond market and issue bonds, and investors buy those bonds. And they get, in exchange, they get a fixed interest rate for a certain period of time. At the end of that period of time, the bond matures, and that would be the maturity date. So as an example, an investor may invest $100,000 in a bond issued by a corporation, and that corporation might pay them, say, 6% a year for 5 years. And so if you invest $100,000, you're going to get $6,000 a year for the 5 year period. And at the end of the 5 years, you're going to get your $100,000 back. So as you can see, because it is very structured, you got a very specific return. You're going to get the interest, and then you're going to get your money back. And
Yep.
because of that, the price and the volatility of that security is relatively low relative to many other investments.
Yep.
And as you were asking, there are several large areas of the bond market, the largest being the US government. Obviously, everyone knows we've got a tremendous debt, and the government goes out and issues bonds. Investors, in turn, purchase those bonds, and that's where the government gets the money they need to fund their business.
Yep.
The other area is, as I touched on a moment ago, is corporate bonds. So many corporations, to needing funds, they go out and issue bonds, and investors in turn buy them for that set period of time, that whatever it might be,
Right.
and they get a return of that interest. And the last big area would be municipal bonds. And so those are issued by different states and local municipalities and other tax exempt entities within the states and cities. And what's unique about municipal bonds is that the interest that is paid is federally tax exempt. And if the issuer happens to be an entity that is within the state that you live, you get state tax exemption as well. So
Mm.
you can get it can be very attractive for people that are in a higher tax bracket, because you don't have to pay any taxes. Now
Right.
the rate might be a little bit less than you get on taxable bonds, but you figure in the after tax equivalency, and it can be very beneficial to many people.
Yeah. Yeah, that makes total sense. And that's helpful to level set us on what fixed income is. Can you just describe a little bit about how buying a bond is different than buying a stock?
Yeah, so as I was saying a moment ago, if you invest $100,000 into a bond, and the bond has a maturity of 5 years from now,
Yep.
you're going to get that interest payment each year, and that's the return you get on the investment. And then you're going to get your principal back at the end. And
Right.
consequently, the price typically on a shorter term bond doesn't move a lot. It might move 2, 3, 4, 5% up and down a year at most for many instances.
Yeah.
Where obviously in the stock market, there are many years where the stock market's up 20, 25%, or consequently also sometimes where it's down 20 or 25%.
Right.
So if you can see if you put a portfolio together that uses both bonds or fixed income and stocks,
Hmm.
even though stocks historically have a higher annual return than bonds, the two of them together can smooth out the results of your investments because many times when the stock market's down, bonds are flat to up to slightly down. So
Hmm.
they mute the volatility and helps investors sleep at night.
Yeah, which is key. I mean, that's a big part of what we have conversations with our clients about, right? Is the ability to stomach the ups and downs of the market. And if your ability to stomach those ups and downs is a little bit less than other folks, then you may want to skew more to a bigger percentage of your portfolio in fixed income. But it's all dependent on how you feel as an investor. So, another question that some folks may be curious to understand more about, and I think would be good to talk a little bit about, would be why is fixed income and why are bonds an important part of a diversified portfolio, especially as it relates to having equities in the portfolio as well?
Great, Andrew. If you could go ahead and pull up that chart, I think a picture will help demonstrate this well. Um, and as this chart shows, and if you look at the last 24 years, if a investor had been 100% in stocks, the best year in that period was up 36%, and the worst year was down 30, they're almost 39%.
Hmm.
But over the entire 24-year period, you got 9.59%
On average, yeah.
on average on annual return. But as you can see, kind of in the middle there, if you invested 60% in stocks and 40% in bonds, you earned a lower return, 7.23%. But at the same time, your worst year was 24%, and your best year was up 24%. So you got a lot less volatility. So
Mm.
really, what this chart is showing in a real good way is that if you look at those numbers on the bottom, and that gives you angst when you see down 38% or down 31%, then you will want to have more bonds in your portfolio to decrease the volatility or your risk. And but you can still get a very good return over that time period. The other thing that is really important is that the timing of when you invest is can make a really big difference on your return, especially in the first 1 through 5 years. Meaning,
Mm.
if I invested right after the market had a big drop, then there's a very good chance I'm going to have a really good return. But the opposite is true. If I invest right after you got a really big run, then I could the first year or two or three could be pretty negative. And so by kind of having more of a balanced portfolio between stocks and bonds, you can reduce that timing risk and you can reduce the volatility in your overall portfolio's return.
Right.
So
Right. I think
that's
that makes a lot of sense.
that's the main reason why we really encourage people to have a mixture of types of securities, including income as well as growth.
Yeah. Got it. Maybe if you can describe a little bit about what types of clients would benefit the most by having fixed income in their portfolio. We have talked before about especially those folks that are beginning to draw on their assets to supplement their spending, once they've retired. may make some more sense to have a stable fixed income portion there. So can you talk a little bit about what clients really benefit from having that as a larger part of their portfolio?
Yes. So as you just mentioned, typically as people age and they get into closer to and actually in retirement, you increase the weighting of fixed income and other income producing securities in clients' portfolios so that they have cash flow to meet their cash needs. And that cash flow is not, is, as we talked about a moment ago with bonds, it's contractual. So as long as the entity's in business, you're going to get the cash is going to come into your account
Right.
versus a stock where you can have a dividend, which can be part of the strategy, but the majority of the return on stocks is you're looking for growth. And as we know, growth is not linear, even though stocks have done well over the long period of time. You do have years where stocks are down and other years where
Yeah.
they're up. So first and foremost, investors that need a cash flow and income stream, bonds are ideal for.
Yeah.
Second, as we discussed a little bit a moment ago, for people that want to sleep at night. So we have conversations with all our clients to learn what their goals and objectives are, and then look and see what their risk tolerance are. And if you put those pieces together, then we come up with an allocation of how much the clients will need in their fixed income part of their portfolio relative to their stock or equity part of their portfolio to achieve their goals and objectives,
Yep.
but first and foremost within their risk tolerance, because we want to make sure that people are positioned correctly for that.
Yeah.
And then lastly, as you talked about, who would be benefit from bonds or fixed income would be people who have some need in the not too distant future. It could be, 6 months, a year, or two years from now. If they need a certain funds for education or for buying a new home or for purchasing a new vehicle, they might not want all that money invested in the stock market for that whole period of time. And so
Right.
putting part of that into bonds or other fixed income can give them a higher return without the risk. And
Yeah.
so that's appropriate in that instance as well.
Yeah. Maintaining the stability of the principal value when, you know, expenses are on the near-term horizon is really important. And while it may, to some who are not familiar with bonds or fixed income and have heard, that either it's boring or, it's not the exciting growth companies in the stock market like you may have heard about, it really makes a lot of sense to shift one's allocation into those types of investments if you're wanting to be strategic about making sure that your money is available for you when you need it. So, any parting thoughts? Maybe if you have anything to leave our listeners with as we, how we think about fixed income as we put together client portfolios.
So one thing we didn't touch on yet, but interest rates, where as interest rates go up, then bonds work in the inverse format in terms of their price.
Mm,
Higher interest rates typically mean that bond prices go down, and the opposite is true. If interest rates go down, then bond prices typically go up.
hmm
And because of interest rate movements and different structures of fixed income securities, a lot of times opportunities present themselves. Um, we had a situation in the last couple of years in 2022 when the Federal Reserve started a very large interest rate movement where we went from zero, basically 0 to 0.25% on short-term interest rates, which is what the Federal Reserve sets, to over 5%. That caused a lot of bond prices to come down, and there was a lot of opportunity in different structures that enabled our clients to get a high return for something that was relatively low risk. So
Right.
the point being, structures and movements in the markets provide opportunity, which is what we're always looking for, to help you get a better return without taking on additional risk.
Right. I think that's a great place to leave it. So thank you for your time, having a conversation here. Hopefully everyone who watched or listened along picked up a little nugget or two, and we'll continue doing this series of fixed income or bond explainer videos, and hopefully they're well received. So thanks again, and we'll talk to you all soon.
Thank you.